Have you ever looked at a big business decision, like buying a new piece of equipment, launching a new product, or maybe even investing in a rental property, and just felt stuck? You're staring at the numbers, trying to figure out, is this actually a good idea? Will this make me money 5 years from now? Or am I about to make a huge, expensive mistake? That feeling of uncertainty is exactly what we're going to solve today. We're going to break down the single most important tool that finance pros, executives, and smart investors use to make these exact decisions. It's called net present value, or NPV. My promise to you is this: by the end of this video, you'll know exactly what NPV is, why it's the gold standard, and how to calculate it, step by step. You'll be able to confidently decide if an investment is a green light or a hard pass. Let's get into it. So, what is net present value? In the simplest terms, NPV is like a financial time machine. It answers one critical question: what is all the future money I expect to get worth in today's dollars, minus the money I have to spend today to get it started? Here's the core idea you have to understand. $1 today is worth more than $1 tomorrow. Why? Because of inflation, for one. But more importantly, you could take that dollar today, invest it, and earn a return. That's called the time value of money. NPV takes all those future cash flows you're dreaming about, the money you'll make in year 1, year 2, year 3, and so on, and discounts them back to figure out what they're really worth today. Then, it adds all those present values up and subtracts your initial investment. The final number it spits out is the net present value. It is the true amount of value, in today's dollars, that the project is expected to add to your bank account. Okay, you're thinking, that sounds finance-y. Why should I care? Why not just add up all the profits and see if it's more than the cost? Because that simple way is wrong, and it will lead you to bad decisions. It completely ignores the time value of money. The beauty of NPV is that it gives you a single, clear-cut answer. The rule is incredibly simple. If the NPV is positive, meaning greater than 0, it's a green light. The project creates value. If the NPV is negative, meaning less than 0, it's a hard pass. The project destroys value. If the NPV is 0, it's a take it or leave it scenario. This method cuts through the hype and emotion. It forces you to be realistic about your future guesses, and it provides a clear, logical basis for your decision. It's also the best way to compare two different projects, say, Project A versus Project B. The one with the higher positive NPV is the better choice. Alright, let's get practical. How do you actually calculate this? It's a 4-step process. Step 1. Identify your initial investment. This is the easy one. How much cash are you spending right now, at year 0? This is your cash outflow, so we'll treat it as a negative number. Step 2. Estimate your future cash flows. This is the hardest part, because it involves forecasting. You need to estimate the net cash flow you expect to receive for each period. Step 3. Determine your discount rate, which we call R. This is the most critical piece of the puzzle. The discount rate is the minimum annual return you must earn to make the project worthwhile. So, what do you use for this rate? It's your opportunity cost. What return could you get on another, similar risk investment? 8%? 10%? 12%? That's your discount rate. Step 4. Calculate the present value of each cash flow, and sum them up. This is where the math comes in. The formula is present value equals the cash flow divided by 1 plus the discount rate R raised to the power of n, where n is the year number. So, for year 1, you divide by 1 plus R to the power of 1. For year 2, you divide by 1 plus R to the power of 2. And so on. You do this for every single year, which discounts each one back to today's value. Then, you add all those present values together, and finally, you subtract your initial investment from step 1. That's your NPV. I know, that sounds like a lot. Let's make it concrete with an example. Let's say you want to buy a new Super Widget Maker 3000 machine. Step 1, Initial Investment. The machine costs $50,000 today. Step 2, Future Cash Flows. You estimate $20,000 in year 1, $25,000 in year 2, and $15,000 in year 3. Step 3, Discount Rate. 12% is your discount rate. Now, let's do the math. For year 1, that comes to $17,857. For year 2, it discounts to $19,932. For year 3, it discounts to $10,000, $48,677. Now, we add those up, which equals $48,466. This is the total present value of all your future earnings. Finally, we subtract the initial cost. $48,466 minus our $50,000 investment equals negative $1,534. Your net present value is negative. The decision. This is a no-go. Even though the machine looks like it makes you $10,000 in profit, it actually destroys over $1,500 of value. You just saved yourself from a bad investment. As you can see, doing that math for every single year gets really tedious. Manually calculating all this can be complex. That's why I built a free, easy-to-use NPV calculator on my website, Fincalconline.online, to do it for you in seconds. You just plug in your cost, your discount rate, and your expected cash flows, and it does all the heavy lifting. It'll save you a ton of time. I'll put the link in the description. Now, before you go, I want to leave you with 2 expert tips. First, the most common mistake is picking the wrong discount rate. This number is everything. If you set it too low, bad projects will look good. If you set it too high, you'll pass on great opportunities. Your discount rate must reflect the risk of the project and your true opportunity cost. Second, don't just rely on other, simpler methods, like payback period. Payback period only tells you how fast you get your money back. It completely ignores the time value of money. Another one is IRR, or internal rate of return. IRR is useful, but it tells you the percentage return, not the dollar amount of value you're creating. A tiny $100 project with a 50% IRR is nice, but a $1 million project with a 15% IRR is usually a much better business decision. Always prioritize a positive NPV. So, let's wrap this up. What are the key takeaways? 1. Net present value is the gold standard, because it accounts for the time value of money. 2. The rule is simple: if the NPV is positive, it's a go. If it's negative, it's a no-go. 3. The discount rate is the most critical and sensitive part of the whole calculation. So, here is your action step. The next time you face a big financial decision, don't just go with your gut, run the numbers. Visit the link in the description, use the NPV calculator, and make a decision based on data, not just on hope. If you found this video helpful and want more in-depth breakdowns to help you make smarter financial decisions, make sure to hit that subscribe button and turn on the bell. Thanks for watching, and I'll see you in the next one.